Throughout the years of investing in microcap stocks, I see certain patterns of what kind of stocks are interesting to microcap investors. And in today's video, I'm going to feature American Airs, which was very interesting to microcap investors. Unfortunately, it's down about 90%. And let's have a look at to see if it's something interesting at this point. If you're new to this channel, my name is Mariusz Konieczny. I run MicroCap Explosions, a website dedicated to microcap stocks, which are underfollowed and ignored by the investment industry. I also wrote 10 books on investing, one of which is available for free download at microcapexplosions.com. I recently also created valueinvestinguniversity.com, which is a free resource that you should sign up for because it's free to make you a more intelligent investor. American Airs went IPO in November of 2019 at a price of 30 cents per share. Very quickly, the price ran up to 70 cents, which was at the beginning of 2020. And since then, it's down almost 90%. And I would say it's a very typical story, a very typical company that microcap investors get excited about because their imagination is big. So let's talk about the business. What does this company do? We know that, or we heard that, when we use our cell phones, we use devices around the house, whether it's Wi-Fi, router, this or that. There's communications that we can see, and they can be harmful for ourselves. So I've heard things that when you talk, you can get, brain cancer, or when you hold your phone close to your reproductive organs, you can not have kids and things like that. And that's because of the electromagnetic radiation. And so what this company does, it has these devices that it sells to protect you from electromagnetic radiation. Like one of the devices, kind of like you put it right here, or you put the device on your keychain, and you're going to be protected, especially now with the 5G being in usage, which creates more radiation. This company, is saying, we're going to protect you. And, the market got very excited about this opportunity. It had got big eyes because it's a big addressable market. The company can make huge amounts of money on this. And it does have revenues. The company does have revenues. But when I look at a company like this, and there's plenty of those kinds of companies on Canadian Stock Exchange, TSXV, or OTC, plenty of them. Imagine yourself being the salesman for this kind of product. Go out and talk to 10 or 100 people on the street and tell it to them. Hey, your phone is creating radiation. It's going to give you brain cancer. But there's this company that has this device that you put it right here. And then when you talk on the phone, you're going to be safe. And then this company's products are the best. They are backed by the college research or university research. We really have the real deal. Other companies pretend like they have something, but it's not the real deal. Ours is the real deal. Most likely what you're going to get out of these people is, good idea. I like it. Wow, very interesting. And then after they say this, tell them, all right, give me 50 or 70 bucks or whatever it is that they're charging, and I'll sell it to you. Most likely it'll be like, let me think about it, right? Because the problem with a product like this is that it doesn't solve an immediate need. It doesn't solve an immediate problem, immediate pain. Compare it to like Voxter, for example, that I have a playlist on this YouTube channel. What does Voxter solve? It solves an immediate pain, which is the bottleneck of the real estate transaction. The appraisals take too long, forever. It solves an immediate pain, right? People will pay to solve an immediate pain. So a product like this would be very successful if you talked on the phone and it gave you cancer right away. Like, oh yeah, people would buy it. But they're talking on the phone every day. Nothing is really happening immediately to their brain. It's a tough sell. So it's hard. It's hard to make a product like this successful. It takes a lot of money to convince people to buy it, okay? And then after they buy it and they stick it on their phone or they put it on their keychain and they pay you $70 or whatever, are they going to buy it again? Right? They buy one time from you. So you spend all this money getting their attention, educating them. So the cost of acquisition is high. It's high because it's not immediate pain and it's not immediate need. So the cost of acquiring a customer is high. And how good is that customer if the customer is only going to buy once? So you might spend $100 or $200 or whatever to acquire the customer, and the customer is going to buy one time from you. It's not a recurring business model, right? It's not. It's just a one-time sale. Yes, they might tell their friend, but it's a one-time sale. And it's also a hardware product. Hardware products usually don't carry high profit margins. And if you look at the gross margin for this business, it's about 26.7% gross profit margin. That's a very low profit margin. Yes, I get it that if they produce it in scale, they can increase it. Okay, but it's still going to be a low gross profit margin product. It's just the nature of the hardware products, right? And then how do you sell it? Well, this company is selling it directly to the customers on their website. And in the past, it wanted to sell through some retailers, like it had a contract with Best Buy. And it's the same situation as consumer packaged goods. To get into retailers, you have to pay the distributor. But you already have low margins. You have to pay the distributor. Then you have to pay for the shelf space. And then you have to send the inventory to them. And they don't pay you until they sell the inventory. And if they don't sell the inventory, they send it back to you. So going the retail route is awful, okay? Going directly to the customer is better. But then obviously you can get a lot more sales if you are in a lot of stores, right? But then it drains you out of cash, which as a shareholder, you're paying for it. If you go directly through to the customer through the website, it doesn't drain you as much, but you can generate a lot of sales. So it's a catch-22. This company is also developing, or already maybe have it, as an enterprise solution to have it put into, the products, whether it's a router or a phone. But then again, that's tough. That's tough because let's say a wonderful situation would be if Apple had it and Apple put it here or inside for every phone. But what's the incentive for Apple to do this? Unless people are requesting this and are worried about this, Apple is not going to do anything about it. So it's a tough business model. So in terms of the moat, there's really no brand. It costs a lot of money to build a brand. There's no switching costs. I mean, just because you buy it doesn't mean you can't put it out. But again, who cares even if you buy it? There's no recurring revenues, no network effect. As more people are using it, more people want to use it. And it's very hard to sell. And of course, it doesn't solve the immediate problem or immediate pain or immediate demand. It doesn't. It sounds nice, but it's tough to sell. So now that I told you what I think about this, do you think it would be a good idea to invest in a business like this? Do you think this is a stock that is likely going to make you rich? Probably not. So why were people paying 80 million market cap for a business like this that barely had revenues of $1 million? But remember, those revenues, not very high quality revenues, but they had no problem paying 80 million market cap. And today the market cap is about 13 million. Barely any cash in the bank. Sales very low quality. You see, people could have prevented themselves from this 90% disaster in the stock price by thinking about the business. Is this business decent? Is this business going to make me a lot of money? Is this a product that is easy to sell? Is this a product that people want to buy? Is this a product that solves any immediate pain or immediate need? None of that. So that's why when I go through all the companies one by one on Canadian Stock Exchange, I look at it and I know immediately whether I'm interested or not. Immediately. And this is not the type of business that I would ever look at. I don't care how cheap the stock price is, how expensive the stock price is. It's simply not a business that I want to be involved in. Now, you tell me your thoughts. What do you think?